Hi everyone, my name is Atishray Malhan and I'm a research analyst here at Abakkus covering the chemicals sector. Unlike most sectors, chemicals is a very heterogeneous industry. Each company is present in different chemistries and value chains. This means that most of the key monitorables, leading indicators, and drivers for growth will not necessarily be the same for two companies in the same sector. This makes it even more critical for investors to follow a bottom-up approach while investing in this specific sector. We can broadly categorize chemicals into two subsectors: commodity chemicals and specialty chemicals. Commodity chemical companies are in the business of manufacturing high volume and relatively low price chemicals that have applications in various end user segments. These companies are widely dependent on global chemical pricing and spreads between raw materials and finished goods for their profitability. This subsector is inherently cyclical in nature and dependent on global supply and demand dynamics. Specialty chemicals, on the other hand, manufacture low volume, relatively higher priced chemicals which are used in specific applications. This subsector is more reliant on continuous R&D to expand a company's product portfolio and is relatively better protected from pricing pressure depending on how many other manufacturers of the chemical exist globally. The chemical sector as a whole has been going through a challenging phase over the past 2 to 3 years, primarily led by intense Chinese competition, difficulties in the agrochemical industry related to higher inventory channels and poor farmer economics, tariff-related uncertainties, and exogenous disruptions to supply chain amidst rising geopolitical tension. The most persistent challenge for this sector, in our opinion, remains the issue of Chinese overcapacity and competition. China accounts for more than 40% of the global chemical capacity and is estimated to have accounted for the lion's share of incremental capacity additions in the world since 2020. While the chemical sector enjoyed unprecedented pricing benefits in 2021 and 2022 due to extended COVID-19 lockdowns in China, the pressure of the subsequent overcapacity has weighed heavily on chemical prices and sector profitability ever since. While there are talks of anti-involution measures to be taken in China that could help with some capacity rationalization, we think it's best to wait for material proof of plant shutdowns and the scale of these closures before becoming bullish regarding a sectoral upcycle. Despite this challenging backdrop, we believe there are still pockets of attractive opportunities in the sector to invest in. We are quite bullish on the CDMO space in the sector. Indian specialty chemicals have been promptly improving their technical capabilities over the years, to the extent that some Indian companies have tied up with global innovators to help improve process efficiencies and also manufacture complex chemicals for them. CDMO opportunities bring with them contractual visibility on future revenue as well as minimal volatility in pricing. For the global innovator companies, the outsourcing of key molecule manufacturing to Indian chemical players helps reduce manufacturing costs and also provides supply chain diversification. We expect companies with strong technical capabilities and prudent capital allocation to continue benefiting immensely from the growing CDMO opportunity. The sector also has select opportunities in the form of companies opting for backward integration and process improvements that can lead to expansion in margins and hence above average bottom line growth. Lastly, in a sector where acquisitions and inorganic expansions are commonplace, we continue to evaluate companies going through corporate restructuring or turnarounds. As mentioned earlier, we believe that chemicals is a sector where it is imperative to have a bottom-up approach going forward and evaluate each company and chemistry on its own merits. Thank you for tuning in.